This is how you double your money in commercial real estate here in Austin, Texas, or anywhere across America. It all comes down to understanding what is your IRR, which is the internal rate of return in commercial jargon. My team's done $1.6 billion in transactions over the past 2 years, and this is one of the most important aspects outside of obviously NOI, your cap rate, and so forth, of course, cash on cash returns. But this lets you know, is what you're investing in actually good for you? Is it beating the stock market? Is it better than mutual funds? Is it beating inflation? And I'm going to show you exactly on this video what kind of IRR you should avoid looking at, what's worth your time, and what can give you generational wealth for you and your family, or for your business, or your trust, and so much more in this quick video. And of course, you want extra help and support down below. Link in the description of the first comment. Call me directly and walk you through the best practices and help you as your commercial real estate advisor get the best deals, whether it's buying or selling. And we broken records almost every single time. Say those clients have over $250,000 before on the buy side, made them over $100,000 on the sell side, and so much more. That being aside, though, IRR is one of the most important aspects out there. Again, IRR is internal rate of return. This lets you know exactly is what you're investing in can help you make more money. And normally, when you look at internal rate returns, this is broken down over years. Just like sometimes 1 year, but normally 3, 5+ years is how you gauge this math. Now, most people who are doing this, especially commercial agents, because we just see so many deals every single day. We look on spreadsheets, we look on, calculations. But for this one, I'm going to walk you through kind of some easy math here, kind of help you how to do this. To understand your rate of return, you want to look at the timeline. So let's say for us, we have 3 years. There's a marker here. So number one on our step, it's going to be, let's say we're buying a $1 million multifamily property. And let's say our down payment is 20%. So it cost us $200,000 to invest in this asset. And let's say that our NOI and our annual net income is pretty low. Probably bad investment here, but I'm going to do easy math here. Let's say on year one, so one is $15,000 that we make. Year two, we make $16,000 on that same investment. And then year three, we make $17,000. Caveat though, on year three, after we stabilize it, or there's some kind of value add up above, a whole breakdown of the best 10 value adds you can do in commercial real estate. It's way more than just doing operationals or expansions. There's a lot of amazing that institutional buyers and people like family offices are doing to maximize the returns on this number. But let's say over here, after we do all sell or refinancing, another strategy there, is $250,000. That means after we add up all these things, so you want to add up our math and get to our equation, which would give us a rate of return of about 19.6. This is our math using a equation because we're generating around $267,000 all said and done, a little more than that. Afterwards, on our money, is how you kind of put the math there. So it kind of sounds complicated, but it's not as complicated as that sounds. And this is a really, really good IRR number. If you can get a 19%, you're doing spectacular. I'm going to walk you through super quickly what kind of rates you should look for when you are investing in your next deal. So you want to take a picture of this, So you have that for your records. And then I'm going to show you the good, the bad, and then the amazing. Because I'll say it's the good, the bad, the good, the ugly. So number one, you do a red pin. This deal here you should not buy. So if it is a IRR of 10%, it's not worth your time more often than not, unless you like having 9-figure net worth already. I'm just trying to protect my wealth, go slow. But honestly, at 10%, like you're not even beating inflation. And more often than not, these kind of deals are like not the cream of the crop. They're not a whole lot of value add. Normally, it's gonna be class A is what you have there. So class A is super safe, super sturdy. It's gonna last you for a long time. But of course, you're not beating inflation just with that alone. Obviously, you add in debt pay down, add in appreciation, and so forth. That has become more enticing for you. But 10%, more often than not, is a bad deal, at least for most people watching this video. Now, the sweet spot for most people when investing in all IRR strategies, so IRR, this is going to be our pretty much breakdown from like 12 to 16%. This is a good deal. This is solid. Like you have a super safe investment, especially 14 to 16% IRR is super safe. That means that this is probably going to be really big on value add of a property you're buying. So you're buying a storage unit or multifamily or RV park. You're adding some kind of value add into this asset. And typically, you will probably double your money in 5 to 6 years at this number. So this is good. And you'll double every 5 to 6 years, which is great. Like you'll definitely outperforming the stock market. You're outperforming most things out there. If you invested $1 million and you doubled in 5 to 6 years, made $2 million, that's spectacular. You're honestly making more money than most of the elites are making. Within reason, elite income is probably like, depending on the age you're at, $200,000 to $400,000 a year. So it's a lower deal. It's by being a small investor. You have an amazing returns for that one. Our next one that we have for IRR in our big math field is going to be 17, just a little above this, to 22%. And yes, they do exist. I have a deal right now with my client I'm working on, and all IRR is going to be around, I think, 18.9%. So like he's getting an amazing return on this property, and that is even before expansion. That's just like doing stabilization to the property. And as of today, we're buying around a 12 to 16% today cap flowing storage unit that he's gonna have amazing returns on. So this is why I kind of like this spot as well, especially this one, because it's easy to get these into the IRR of a high 18, 19, 20%. At least normally when you find deals like this, it's going to be properties that are underperforming, mismanaged. It's going to be desperate sellers who are super distressed. You be doing better marketing and branding. It's also a big part of this. Great debt terms. It can be seller financing, credit financing. Maybe a lender you have has an amazing promotion right now that can get you amazing returns on it. It can be a super spectacular cap rate. Again, all these strategies going to be a lot. On this one, you will probably see a doubling of your money every 4 to 5 years. So in 4 or 5 years, you're going to double your money. If you have $1 million in there, that is at a top 1% income that you're generating from an asset. So this is great. And then there is one step above. One step above with all the unicorn deals, which is pretty hard to find. Normally, you have to create this kind of strategies. And this IRR is 23% and higher. This is what I would call elite. And you obviously know my real estate team name is Elite Real Estate Group. So we're all about elite strategies here. And this is going to be the cream of the crop. More often than not, you're buying at a majorly below market value. It could be major turnarounds. It can be a super heavy rent increases. Let's say that the property had increased rents because mom and pop owned for 10, 20 years. Not likely, but it happens. And that is an easy value add for you. It could be another value add could be like, redevelopment. It could be a strategy of operations, better management. All these things can help you get to these amazing returns. It could be rezoning place. And obviously the biggest one is going to be redevelopment or development as a whole is the strategy here. And this is your gauge you can now look at moving forward. And if you can find deals that are already like this, just know we're probably paying top dollar for these assets. And if you're looking at deals that are more like this one, and even sometimes, like, I'm not saying you should never buy a bad IRR deal, because those bad IRR deals can eventually become a good or a great one, and sometimes an elite one. But this is your guide to now understand IRR, the math behind it. Down below, I also have a whole link for you too on my expressions that I use to do our math for IRR. Totally for free, no opt-ins, nothing like that. Easy to get down below for you too. And of course, you want more help, more support. Make sure you smash that like button, tag your friends, use the show. I make new videos for you every single day, all things commercial real estate. And you want more support over here of a whole breakdown about all things underwriting transactions, whole playlist that shows you everything about commercial real estate for $1.6 billion transactions by team, so much more. And of course, you want extra support down below, link in the description, the first comment section, how to call me directly, no obligations, but I can walk you through the best practices, strategies, and systems to help you get the best returns on your money, whether that is buying or selling in your next commercial asset. Hope this is helpful for you all. Down below, let me know what of these 4 categories is your favorite and why. Do you love buying deals with terrible IRRs, so you know it's going to be a easy deal to buy way below market value and then turn it into a big deal? Or you more of a, hey, I want to play super safe, buy a high IRR, double my money every 5 years or less, and go from there. And then for doubling money too, for this one, this can be a double, a triple, a quadruple your money in the next 2 to 3 years. So like this one is super, super high. Again, thanks for watching. Have the best day yet. I'll see you at the top and glad you're here.